Thanks, Barry. So let me start by talking about the process of how I look for stocks. David and Barry spent a lot of time thinking about broad themes, for example, investing outside of North America, or the rise of millennials. So I take these ideas, and then I dig deep in for companies that I think are going to benefit from these trends. Both companies that I'm going to talk about tonight go into the category that David would put into the category as trading in North America, but with a meaningful portion of revenue coming from international markets. The first company is Activision Blizzard. Activision Blizzard is one of the world's largest video game companies. You might have heard of many of their key titles, such as Call of Duty, Overwatch, or Candy Crush. Today, around half of Activision's revenue comes from outside of North America, with a meaningful portion coming from Asia. And anybody who has grandkids knows that millennials play a lot of video games. Seems silly for me to have to say that. We think that the video game industry overall is an attractive place to invest in. First of all, video games are addictive. Researchers tell us that video games hit the same spot in your brain as gambling does. Secondly, across all ages and genders, people are playing more video games, whether on their computers, on their Xbox, or even on their phone on the subway. Last of all, video games are non-cyclical. Your 12-year-old son or grandson isn't going to stop playing Call of Duty just because the stock market falls by 20%. So over the last 15 years, the internet has transformed the video game industry. Not too long ago, when I was a kid, if I wanted to play Call of Duty, I would walk to Best Buy, pay $60 for the game, and that would be the end of that. Today, if I wanted to play Call of Duty, I would still pay $60 at Best Buy for it, but I would play for hundreds of hours online, and if I wanted to get the full online experience, I would have to pay a lot more for additional weapons, costumes for my character, and additional online content. According to one estimate, it would cost you over $1,000 just to unlock everything in the previous iteration of Call of Duty. Here's another figure for you. How many people in this crowd play Candy Crush? I guess not that many, but okay. For those of you who don't know what Candy Crush is, it's a free game on your phone that you play to waste time by matching candies and stupid stuff like that. But the way Candy Crush works is that you're only allowed to play 5 times every day, and if you lose 5 times, you have to wait half an hour before you can play again. Of course, you're allowed to pay, so you don't have to wait half an hour. Although only a fraction of people actually decide to pay, those who do paid $24 per month just so they don't have to wait half an hour. Just think about that for a moment. Today, these Call of Duty map packs and extra turns on Candy Crush make up 70% of Activision's revenue and an even greater percentage of their profits. Because the player is already heavily engaged with the game, Activision doesn't need to spend anything on advertising to convince you to pay for these things. And as you can imagine, it doesn't cost Activision anything to allow you to play Candy Crush half an hour earlier. So we think that there's plenty of opportunity for Activision to continue to make money from these microtransactions in the future. Another exciting trend that we like for Activision going forward is eSports. So what the heck is eSports? eSports is basically a fancy term for video game tournaments, which some people think are sports. I'm not going to stand here and debate with you about whether video games are sports or not, but what you do need to know is that eSports are big. Today, more male millennials watch eSports and video game tournaments than they do for NHL hockey. And just in July, over 20,000 people paid over $150 per ticket to watch the finals for Activision Blizzard's Overwatch League at the Barclays Center in New York. This game was also broadcast live on ESPN. In January this year, Twitch streaming site, which is a streaming site for millennials, signed a deal with Activision to pay $90 million for the streaming rights to Overwatch. And here in Toronto, in August, a group of investors, led by the former head of the Canadian Olympic Committee, paid $35 million to Activision Blizzard for an Overwatch League expansion franchise. And we're still in the first inning of eSports. Over the next few years, we expect that Activision Blizzard will fully participate in all of the industry growth, including eSports, and that the shares are very reasonable given the potential. Another stock that will benefit from growth outside of North America is Ferrari. As with Activision Blizzard, 2/3 of Ferrari's business comes from outside of North America. And the Ferrari brand name means the same thing whether you go to China or India or Brazil or Nigeria. And so it is a clear beneficiary of growing wealth, particularly in emerging markets. The key to thinking about Ferrari is that although they make cars, it's not a car company, but rather it is a luxury goods company. No one buys a Ferrari because they think it does a particularly good job of getting you from A to B. Rather, you buy a Ferrari because it's like buying a Rolex. You buy it because of all the symbolical things that it represents and the looks you get from people when you drive it around. In order to maintain the brand prestige, Ferrari deliberately limits the amount of cars that it sells every year. All of its cars are currently sold out for the remainder of 2018 and most for 2019 as well. So if you walked into a Ferrari dealership today and you tried to buy a new Ferrari, you can't do it. And because the waiting lists for Ferraris are so long, their cars actually rise in value when you sell it. So why does any of this actually matter? Why does it matter if Ferrari is a car company or a luxury goods company? It matters because most car companies, even luxury ones like BMW and Mercedes, have very low margins and very low returns on capital because they continually need to spend money on advertising, on financing incentives, and producing inventory. By contrast, part of what makes a Ferrari is how expensive it is. A Saudi prince buying a Ferrari isn't haggling with his dealer about whether to include free heated seats on his new Ferrari. He already knew beforehand that he was going to buy the Ferrari, so Ferrari doesn't need to spend anything at all on advertising. So what you get is that Ferrari is a money-making machine with a financial profile that much more looks like a luxury goods company than a car company. Just a month ago, Ferrari announced its new Ferrari Monza SP1 single-seater, which costs around $1.75 million US per car. You had to be one of Ferrari's most loyal customers to be invited to buy the car, and as of the announcement date, has already been completely sold out. How many companies in the world can do this? So we think that Ferrari can easily raise its production by a few thousand cars per year without much damage to its brand name, while continuing to raise prices for the foreseeable future, and that the share price is very reasonable today given the potential. And with that, I'll pass it back over to David for closing remarks.